today's webinar, we'll go ahead and dive into our content. We are going to be talking about finding your first deal for apartment syndications. I realize that not everybody listening today is in syndication. You may just be looking for some rental properties, maybe a 5-plex or a 10 unit. And those you may not be looking to syndicate, but that's what we do here at passiveinvesting.com. Is syndication. And I know a lot of people that are interested in that model. And so we're going to talk a little bit about that today. We'll start by just talking about what is syndication. I think most people understand the concept, but really what it is pooling investors together for the equity piece of purchasing multifamily. So, you have a network of investors that know, like, and trust you. And you go and look for deals, and then you present the deals to your investors and with specified returns per deal. And you can do that under different SEC regulations, 506B, 506C offerings. Each of those have different regulations, but that's basically syndication. We're pooling investors interested in investing in multifamily, but don't really want to have all the time invested in of operating. So they put their money with you as the trusted operator, and you give them the returns by operating the property according to the business model and the underwriting. So what we want to talk about today is getting or finding your first property or multifamily syndication deal. There's so much that goes into this. And that is one of the first steps is be willing to put in the work. That's always the number one step. I see so many people that accumulate information and never take the next step. And I'm going to touch on this again at the end, but when you listen today, hopefully I provide some good content for you that you can put to work. But make sure that whatever content you get or whatever information, whatever knowledge that you gain, that you put it to work, you put it to action. And hey, we got some people that are ready to take action now. So I'm glad to hear that. And I got one comment too that says, Norton says Rehab Wallet is a known dangerous site. I'm not sure why you're getting that notification. So just maybe need to tone down the internet settings. So, but we're not haven't had, that's the first time we've heard that. So thank you for bringing that to our attention. We'll check into that and make sure we get that working. But we want to make sure that we give you some good content today. So let's jump right in. How to select your market. Your market in multifamily is just where you're going to buy. We talk about this often. You can say, oh, I want to buy apartments. Okay. Where do you want to buy apartments? Do you want to buy East Coast, West Coast, the Southeast, Northeast, the Midwest? It's endless when it comes to that type of question. What market? And then once you get into that, you say, okay, I want to, for instance, we invest in the Southeast. Say, okay, I want to invest in the Southeast. Where in the Southeast? Because there are thousands of cities in the Southeast that you can invest in. So you need to narrow that criteria down. Our specific criteria, I'll just tell you what ours is. This doesn't mean, it necessarily applies to everybody listening here, but we like the Charlotte, Raleigh, Atlanta, Jacksonville, Charleston, and Greenville, South Carolina markets. We like those markets based on the economic drivers. So those blue chip companies that are there in place. These are big companies with proven growth records that draw, that have great employment and that, provide income to the people that are going to be our occupants, our residents, our customers, really, in our multifamily property. So you want to make sure you choose a city that has those items. I'll give you an example of something that we look at. We talked about the blue chip companies, but I'm located in Columbia, South Carolina, and this is not a negative on Columbia or investing in Columbia. This is something that we personally look at when investing in Columbia. Columbia has a very transient population. So they're known for USC, the Gamecocks. They have the largest Army military base in the world. And then we are the state capital. So you have a lot of revolving door of population. You have a few things that are affected if anything happens with schooling. For instance, if people go to virtual learning, your student housing may be affected in that population, or some of your multifamily. So those are some things that we look at. If you have an administration change and, you know, they cut back on military spending, you may see a drop in the number of soldiers that you have on the base, which may affect, you know, the population in that submarket. So those are some things that we look at that would be like a negative why we don't invest actually where we live. And again, that's our own personal criteria. You know, I don't want to deter anybody if you're looking at Columbia, South Carolina. It is a great place. I live here. But those are some factors that we look at. So, and then when you get to so let's say you selected a city, okay, for Charlotte, for instance, is one of the cities that we look at. Charlotte is, you know, you can't just say, okay, Charlotte, and just throw a pin at the map and pick an apartment. There are multiple different layers and areas within Charlotte, some good, some not as good, some are up and coming, some are, you know, on the downslope. So within each city, you need to make sure that you are picking a submarket that has growth. And, you know, we can look at, I want to look a little bit at a product that we use. And this is something that you can add value to yourself with, is CoStar. I know it's a little bit expensive, a little bit might be an understatement, but it's well worth it if you're going to, you know, grow in this industry. And I'll show you some of the reasons why. Let's look at, this is a recent acquisition of ours. Hopefully everybody can see that. This is 1000 Heathmore Lane. This is Braxton, Cary Weston. This is one. Somebody just put everything's showing up good there in the chat box. I want to make sure everybody's seeing this okay. I'll wait and make sure everybody can see that. Yep, good. All right. Okay. So this is CoStar. So this is where we're going to check a little bit about submarkets. Okay. So if I go, this is the property, this is the summary page. You can, I won't get a lot into this detail, but you see it's pretty endless. I can scroll down, all kinds of photos of the property, how much it's been appraised for, who owned it, where the occupancy levels are. So these are some great data points when you're looking for a property. But let's talk about the market, right? The correct submarket. So if I go and pick demographics, this tells me my population in 2010, my population in 2020, and you can see the radius, 2 mile radius, 5 mile radius, 10 mile radius. And that's going to give you a good indicator of that very close submarket within 2 miles, if it's growing or not. And you definitely want a growing submarket. Here's your projections, 2025 projections. And then you can look at all the different breakdowns by ethnicity, income levels, median housing, home values. So this is a very important factor right here. Income levels. You want your rents to be 1/3 of the median income of your property, so they can afford to live there. Here's your population numbers here. All right, so these are some of the things that we look at when we're looking at a specific sub-market. This one's in Raleigh. So that's just a basic summary there. So that's kind of how you start you got to start by selecting your market. You got to know where you want to buy at. So that's number one. Number two is choose an asset class and deal size. Asset class. What am I talking about there? Again, you know, for those, many of you are experienced, you're in this industry, you know what I'm talking about, but some of you are just starting out. You really don't understand. You really have A, B, C, and D. And you have kind of subsets within those. So A class is going to be the top. You have some triple A, which is going to be your high rise luxury apartments. Then you're going to have your core plus A, where it's just, you know, they're relatively new. That's really what's defining this, is kind of how new they are. Your class A core plus, it's like they're probably like a 2015 vintage, you know, what year they were built in is the vintage. and maybe they have a little bit of room for some value add. You maybe update some flooring or some fixtures or something like that, but not real heavy. So that's your A class. Really stable, high occupancy because they're newer. Not a lot of deferred maintenance, so not a lot of capital that's going to need to go into it to bring it up to par to that add value there. So you're really looking at the Class A assets to add value in operations mostly, and advertising, marketing, things like that. Class B, that is obviously your next step down. It's going to be probably in the 2005 to 2010 range, roughly. These are rough numbers, but that's about how I judge the B class. You're going to have a little more value add here. So, you may be looking at maybe a $5,000 to $7,000 per unit renovation cost to push rents. So, it's not as new, it's not as up to date. The colors and the fixtures are a little more dated, but it's still a nice place. Good bones, as we say, good renter base, again, high occupancy. And you're going to have to put a little bit more money into that. So that's your B class. C class is going to be kind of really, in my book, your entry level. This is going to be your 70s, 80s vintage, maybe even early 90s vintage. It depends on where it's located. This is going to be defined by really where your residents work, what type of industry are they in. We call it maybe a little bit more workforce housing than your A class. That would be A, and your upper B class, which would be maybe consultants that work from home or different things. So your C class, the way I tend to look at that is it's people that have to rent. Tends to be, it's not always the case, but they have to rent maybe because they can't afford their own home, or it's not what they choose to do, but their income level may restrict them from buying a home. Whereas your A class, it tends to be people that are choosing to rent because of the convenience of it, or maybe, like I said, they're a consultant. They tend to move around a little bit, and it's easier for them to rent because they don't have to deal with mowing the grass and all the rest of owning their own home. So that's some of the difference in the classes. Your C class is going to be really your entry level. The D class is really not anything that we really look at. I've heard people say it's D stands for danger. It's you got high crime. It's really something you want to steer away from, but that is your lowest asset class when choosing that. And so you want to pick which one you want to go with, and each one, has their own aspects that may be attractive to your investment model. So, don't let someone, if they're, like we're investing in upper B and A class assets, that doesn't mean that, you should invest in C class, or it doesn't mean that you can't find a D that is a diamond in the rough and you can turn it around. One thing we have learned is that it's hard to change the reputation of a neighborhood. So you can, as I say, put lipstick on a pig, but it's still a pig type mentality. So the neighboring community knows a neighborhood for its reputation. So if you've had high crime in a neighborhood and it's a D class, maybe some drug activity, and you can paint it and you can renovate it and you put granite and stainless and all the rest, make it beautiful, it's going to take time for that reputation to change. And you can do that. It can be done. It's just going to take a little bit more time. So don't discount the reputation of a neighborhood when you're trying to purchase one. So just a little side note on that. And then deal size. That's something that you really need to nail down, and that's based on the syndication model. What can you purchase as the operator or the sponsor for the syndication group? What is the net worth requirements? What is the liquidity requirements for the loan that you're going to have to get? So some people will bring in a key principal or a loan guarantor if they don't have enough net worth or liquidity to get that loan for the property. So don't let the size of the property necessarily hinder you. There are a lot of people out there that can be KPs, key principals, or loan guarantors, obviously for a fee, but don't let that just hinder you because of the deal size. But pick one. Also, the thing you need to keep in mind is if you're doing a syndication, you're going to have to raise money. So you have your debt piece, and you're going to have your requirements for net worth and liquidity for that. And then you're going to have your equity. Okay. And that's what you're raising money for. And so you kind of need to have a feeling for how much you're going to be able to raise. Because I'm going to get into this a little bit. Well, I guess this will be a good transition into the next point here, is tips for building your broker network. When you start building relationships with brokers, they are not wanting to waste a lot of time with people who aren't serious. And so if you start, let's say you get a deal under contract, and you weren't confident, or you weren't quite sure in your ability to close the loan or raise the money, and that deal drops, you're going to tarnish your reputation as a closer. So be very careful, especially when starting out, to keep that reputation very, very high. That's my number one advice to anyone starting out, is to just protect that reputation. And there's a Bible verse that talks about a good name is to be desired above much riches. And I can tell you it's going to be hard to make riches, if you have a reputation for tire kicking, if it will, because they'll the next deal that they see your name come up on, there maybe will not want to give you a shot, because it kind of wastes their time. So be very careful. Know what kind of deal you can take down based on net worth and liquidity, and know how much money you think you can raise. And just, I know that's kind of hard to judge, especially if it's your first deal. You may have some friends. Oh yeah, I have family and friends that said they'll invest with me. A lot of times when it comes down to it, when it actually comes time to pull the trigger, there are less people that are actually willing to invest. So, you have a lot of people say, oh yeah, sounds great. And then when it comes down to, the ACH transfer or writing the check, you don't get as many as you thought. So just be cautious of that starting out. But one of the biggest things about getting started is taking that first step. It really is a step of faith. You really have to get uncomfortable. You really have to push the bar. And that's part of that mentality. So it's mitigated risk, if you will. You can't foresee every downfall, but that is the biggest growth, is the mistakes that you're going to make. You will make those mistakes. And I'll touch again on that a little bit later. So broker network is the next thing. It's very easy. Once you've chosen your market, then you can simply Google multifamily brokers for, Charlotte, and then it'll pull up many different brokers. So your big broker firms that we deal with, and the size that we deal with, are going to be NKF, Cushman Wakefield, JLL, Berkadia, Capstone, CBRE. I think I covered all of the major ones that Walker Dunlap. Those are all the major brokerage firms that we interact with on a regular basis. And then they'll have teams within that firm for the Southeast. And then they'll have, maybe like for us, they'll have a North Carolina team and a South Carolina team. And then on that team, you'll have, a hierarchy, and you got to know and learn who it is that you need to talk with, build a relationship with that person, whatever field you're interested in. There are also some secondary brokers, not from the big firms. So if you're looking at a smaller property, like a small balance loan type property, those types of properties are probably not going to be listed through those big brokerage firms that I just mentioned. So, but you should be able to pull up those brokers within the network just by Googling. Okay. And then what they're going to want to do, or what you should do, is go and meet them, have coffee, just tell them what your investment criteria is. And that's why I have it in that order. You need to know what, your market is, what your asset class and deal size is, because they're going to ask you those questions. What are you looking for? Are you looking for core plus? Are you looking for value add? What size deal can you take down? Can you, is it 1 million? Is it 5 million? Is it 100 million? Those questions are questions they're going to ask you. And then they'll say, well, where's your equity coming from? And that's a big question. That's probably the number one question that brokers are going to ask, and sellers. When we have buyer interview calls, when we have a deal that we're bidding on, and they'll ask us questions, the buyer will ask, the seller will ask us, the buyer, potential buyer, questions. And one of the major questions is, where is your equity coming from? And I will say that when you get up higher in the deal size, the 50, I would say over 50 million, there are less syndicators in that field, just because of net worth and liquidity requirements. So I do have a question of what kind of broker. I apologize if I didn't specify that. We're talking about, these are multifamily brokers, real estate brokers, that list multifamily properties. That's all they do. There will be some commercial properties within those firms, but you want to get with the multifamily team if that's what you're interested in. There are brokers for storage. There are brokers for mobile home parks. There are brokers for all kinds of stuff. So we're looking for multifamily real estate brokers. And I've said this multiple times. I hope I'm not sounding redundant if you've ever listened to me speak before, but broker relations is crucial to getting deals because it is a personal relationship. If they don't know you, if they don't have confidence in your ability to close a deal, if they're not willing to put their neck out and say to the seller, hey, I think you should pick this group here, then it's going to be hard for you to get that first deal. So build that relationship, get coffee. If you're a golf, if they like to fish, take them fishing, whatever, build that relationship. Make sure you stay in contact, emailing when you see deals come through. Make sure you're just touching base, even if you're not necessarily don't know if you're going to bid on that property, just ask some questions. One thing that I want to say is, when you get a good relationship with the brokers, is you can just ask them when a deal comes out, you can say, okay, what's the pricing on this? Where is it going to trade at? What's your guidance? And they'll either give you a per door basis or, per door price, or an overall price, which you can just obviously divide by the number of units and come up with a price. And you can use that in your underwriting model to decide if it works for your investment criteria. And, everybody's investment criteria is different. What are you offering to your investors? That's going to affect whether the deal will work for you or not in your particular group. So that's something, you'll just have to know. The brokers are going to ask questions to see if you know what you're talking about. It's okay if you don't know everything. I remember our first trip to Charlotte to go meet all the brokers from all the different firms. We just made a whole day of it. I think we drove 20 some multifamily properties and met with 6 or 7 different brokers in Charlotte. And they're asking us all kinds of questions. And I'm sure our answers were not perfect. I know they weren't perfect, but you learn and you grow and you make mistakes, and that's part of the process. You learn more from your mistakes than you do from your successes. So the biggest thing, again, I'm going to say it again, is take action. Make sure you just take that action and go ahead and take those steps. Different ways to stand out in the crowd. Again, there are going to be a lot of different groups out there. There's a lot of people that want to bid on these properties right now. Multifamily is a very popular investment vehicle because of its stability through COVID. The debt rates are low right now, so a lot of people are jumping on board, trying to get some deals in. So it's very busy right now. On average, when we are bidding on a deal, first round, there's going to be around 30 or so people bidding. Now, some of those are going to be low, and some of those are going to be, they're a non-factor. And let's see. Yep. I was just reading some of the questions to make sure I had covered everything, but there's going to be multiple people that are still bidding on this. So about 30 people, some of them are going to be non-factors, and that's going to get weeded out to probably around second round, maybe. If you're lucky, there's only going to be 5 in best and final, and then they're going to get down to 2, and then they're going to want another bid. And so you really have to work on ways to set yourself apart or to stand out in the crowd. You can do that in many different ways. And it's really a personal flair, if I can say it that way. You really need to make it your own. Different things. We've mentioned this before. One time we were looking to, I'm going to go back to the CoStar page. I'm going to pull up. This is another one of our properties. When we were bidding on this property, we were unknown to the broker. This is the first time we had transacted with them. So trying to build that confidence level, trying to stand out. I had already toured the property with property management and taking a look at everything. And as managing partner, that's all that you really need to do. But we were trying to really stand out in the crowd. So we actually, and this may sound excessive to you, and so I hope it doesn't, because it was done for a reason. So we chartered actually a jet for only the purpose of setting ourselves apart. Dan, Danny, and myself, all three of us got on the plane and on the jet, and we flew up to Carrington. We made sure we voiced that to the brokers, say, hey, we're going to be flying up there. We want all the managing partners to, take a look at this, because we really want to get this property. We're really confident in our ability. And it was just a show is all it was. We don't fly in jets privately all the time because it's a waste of money, in my opinion, unless you just have tons of cash sitting around. But we did it for a reason, and it worked well in that instant. And then when we got into the best and final round, the seller actually used to be a syndicator back in the day when they first started. And so he understood our model, but he was unsure that we could raise the equity. And what he doesn't want to do is put it under contract and have it go out 30 days, and then we can't raise the money, and then he has to relist it again, and that's bad for their business. So what they wanted us to do is double our hard money. So hard money is non-refundable money. So you have earnest money, like when you buy a house, you have earnest money that you put down, and that goes into an escrow account. So they have an escrow agent that decides whether, if, the transaction doesn't go through, who gets that money. It's a third party. But it's usually refundable based on terms within the contract. So in order to get this, we had to actually double what we had put in there in our original contract to put ourselves above and beyond anybody else in that deal. And then finally, the final step was they wanted us to not put the money in escrow, to really prove that we were going to close this deal and just to stroke them a check. Now, I don't recommend that unless you really understand who you're buying from, because not everybody is as trustworthy. So that was a risk that we took, that we were willing to take. That was our personal money as managing partners. But it was able to set us apart. We did do some reference checking before we did that, called some other brokers, and that goes back to the broker relation. And we, call them and ask, hey, are these trustworthy people? Is this a trustworthy group? And they're a big firm, West Coast, well-known, so they have a name to uphold. So we were confident in that, but that was just ways that we've set ourselves apart. And there are different ways that you can do that in the negotiating process, and each deal is different. One thing that I'll do when I'm talking to the brokers is try to learn the psyche of a seller. One thing is call for offers date. We call it CFO, call for offers. And that's on a specific date. But everybody that's bidding wants to get a feel for where the pricing is coming in first before they submit their offer. And that way they're not overpaying or anything for the deal. So they'll wait sometimes till the next day to submit their offer. Well, that's okay if you've checked with the broker and you know that the seller is okay with that. But some sellers are in their mindset are like, if this group can't even get their offer in on time when we set the date, how are they going to be able to close the deal on time? So I'm not going to even pick them. So you got to be careful, and you got to know the psyche of the seller and know kind of where you are at in that process. So I have a question. What time frame was this deal? That was from Michael. Time frame as far as when we purchased it and which deal are we referring to? I had a couple pulled up at Carrington at Briar Creek, pulled up right now. So the Carrington deal we bought last year, the Hudson Cary Weston, or sorry, Braxton Cary Weston, this one, we just closed on this one a few weeks ago. Pull this deal back up. A few weeks ago, we closed this deal. We closed one deal during the middle of COVID, which was pretty rough. So the Carrington deal, how long did it take to close that deal? That was a 21-day due diligence and a 30-day closing. And that was another aspect that the seller wanted us to do is to shave that tight and no extension after that. So let's say, the bank wants to do a soil test and they're concerned about a neighboring dry cleaner that has nothing to do with your property, but it's going to delay it, and you go past that deadline, you can lose all your hard money. So not having an extension option is difficult. Also, another reason for that is if something like COVID comes up and you need to extend. So it's nice to have that option in there, but you can't always have it. And that's where that getting uncomfortable and being confident in your team comes into play. So 2130 was the Carrington closing. And then most of our deals are going to be a 30-day. They're going to be a 30-day due diligence, a 30-day closing after due diligence. And then we'll have a 30-day extension option with some additional earnest money that goes towards the purchase price. From broker contact to closing, you're probably talking around 90 days, I would say. So the deal's going to come out, and that varies because every deal is different. They're going to, some deals are real quick and they want to get it closed quickly, especially off-market deals. Sometimes I'll only have a couple of days to underwrite it, which is insane to try to get a deal under, to understand a deal within a couple of days. And those will close really quickly. We put one under contract in Greenville the same day we were contacted. We happened to be in Greenville. We drove to the property, did a drive-through, put an offer on it, got a countered that counter, put an LOI, official LOI in, and had it under contract the same day. So they can move real quick like that, or, they can go slow sometimes. So it just depends on the deal. I'm going to touch on a little bit of the questions. At what point do you start reaching out to investors to raise money? So with the SEC regulations, this is not a fund. Okay. So this is an investment per deal. So we raise our money from contract to close. So we do not send the deal out to our investors until we have put it under contract. One of the main reasons is we cannot give projected returns until we have the price settled. So if the price is still being negotiated, that's going to affect the projected returns, and the projected returns are going to be in the private placement memorandum that we send out to all of our investors. So that means you're going to have, on a normal deal cycle, you're going to have about 60 days to raise that money, the equity piece in that. So, but in some cases, like I said, the 21-30 model, you just have less time. I was working on a deal last week, and we were down. It was just us and another group, and this other group was a cash buyer. They were not using debt, which puts us at a huge disadvantage. But we were trying to win that one based on pricing. But the cash buyer came in and did a 9-day due diligence and a 21-day close. So that was the total cycle, which is insane. Never seen that before. Never even heard of that before. And, that's one of those things. Put a lot of work into that deal. 5 or 6 different versions of underwriting. I flew to the property and toured it, spoke with the broker multiple times, had multiple conference calls, did pro formas with the management company, and all for naught in the end. But don't be discouraged when that happens. We look at hundreds of deals, and we only buy a select few. That's just part of the business. But don't be discouraged. We've had deals where we lost them. The seller said, after the fact, the buyer they chose started fumbling the deal, and they said, well, we should have gone with you. And then the next deal they had come out, they gave us the deal. So just because you lost this one doesn't mean you're going to lose the next one. So here's another question. Let me clear some of these out here. Can you put equity raise as contingencies in the PSA? You can. It's not going to fly well with the seller. They don't want any contingencies that are dependent on your ability to close. So the aspects of the property you want to put, make sure the phase 1 environmental is good, make sure the title and survey are good. Those types of things are fine to put as contingencies, but to put any type of financing or equity contingencies on there are going to be frowned upon, because that right there, by putting that contingency, speaks to your confidence level in raising that money, if that makes sense. So I would not recommend that. But it depends on the deal. So I will back up a little bit on that. On the smaller deals, if you have a mom and pop operator, it might not be something that's out of the question. They may work with you, but on these big ones that we're dealing with the, the big brokers, they don't want to see that. So on the small ones, don't be afraid to ask that question. All right. Well, we are going to need to wrap up pretty quickly here. I think I've gotten through most of the questions. Again, thank you for joining us. Next Tuesday, Dan Handford will be on, and he will be, let's see here. I'm going to pull up this and see if it got updated here. Sometimes it updates, and we'll put the next topic on that. But anyways, Dan will be talking about how to, it's my family right there, if you saw that, how to build a track record where you can raise millions to start your first syndication. So how do you get this investor base? How do you build a track record of success? And Dan's going to be talking about that next Tuesday. So be sure to join next Tuesday, Dan Handford. And in the meantime, have a great Thanksgiving. We appreciate all of you joining, and we hope to see you at the summit coming up in January. Everybody have a good day.